I've heard you describe how this works, and I think for those that are not traders that haven't grown up with understanding commodity markets, it might be helpful. And secretly, I kind of want to hear you explain it again because it's not the most digestible of concepts. Could you explain how it works from start to finish on the buy side, on the sell side, what it looks like?
Yeah. So just kind of take a step back again, starting and just kind of looking at the product. Again, we see hash rate as a commodity. We want to build the entire suite of products that miners can use. And when we looked at what was available, right, there's power purchase agreements on your cost side. You have Bitcoin derivatives that help you hedge your treasury and your holdings. But there wasn't really much on the revenue or cash flow side. We saw a small patchwork of what's called physically delivered forwards that were out there. There was Bitcoin futures, which existed. And so we wanted to do something hash rate and miner specific. So like I said, we have this hash price index already as part of our site. And that's kind of the first thing to understand is that there's an index for what you're earning as you're mining. And that's what you can expect to earn from your mining pool. And so our derivatives products are based around that index. The first product that we decided to launch was called a non-deliverable forward. Okay, and so a forward is really your most simple type of derivative, although derivatives, of course, are a complicated topic. And what a forward is it's just an agreement between a buyer and a seller to deliver a pre-agreed quantity of a commodity on a future date at a fixed price. And there are typically two types of forwards. One is called a physically delivered forward, which you actually deliver the commodity physically to the seller. And then the other type is called a non-deliverable forward, where instead of actually delivering and paying the full purchase price for the commodity, what you do is you pay the difference between the final market price of that commodity and the pre-agreed fixed price. That delta, that difference between those two prices is paid from the buyer to the seller if the price of the commodity falls, and from the seller to the buyer if the price of the commodity rises. And so, there's pros and cons to physically delivered and cash settle. We decided to stick with cash settled just because it's the kind of simplest, easy to use, and we believe it'll bring more liquidity into the sector. Part of the problem with a physically delivered forward, and these have been tried before in the mining space, is external capital doesn't quite know what to do with physically delivered hash rate. Imagine you're an investment firm in New York or London. You would much rather not have to actually take delivery of hash rate, and that's what you see in derivatives markets, just kind of generally. The cash settle markets tend to be much larger, but of course there are drawbacks in terms of upfront financing and things like that, which physically delivered forwards can meet. But for us, we started with what's called a non-deliverable forward, and that's sort of a complicated explanation. Apologize, but there's just kind of the background. Now, our product is fairly simple. We match buyers and sellers along three variables. Our contracts are really just three variables. There's what we call your unit hash price, which is that pre-agreed fixed price that we were talking about. So if you're a miner, you're able to sell forward at a pre-agreed fixed price. There is the daily hash rate that you're putting under the contract. And then there's the number of days that you want that contract to run. In terms of the hash price that you can pre-agree to, we have two different classes of products. We have our US dollar denominated product, and we have our BTC denominated product. The BTC denominated product protects you in terms of your exposure on the network difficulty and transaction fee side, whereas the US dollar contract sees protection as well on the Bitcoin denominated price, and different miners with different obligations and different strategies use those products differently. In terms of the durations, we have standardized monthly contracts that run 1, 2, and 3 months forward. But we also have the ability to put together custom contracts. The only real limiting factor is our ability to match buyers and sellers amongst those three variables that I mentioned. And then, of course, at Luxor, on top of matching buyers and sellers, we also manage counterparty risk. So you face Luxor when you're trading these products. You don't have to worry about tracking down the buyer or the seller on the other side of the trade. All parties face Luxor. We also have a position manager tool where you can monitor all your trades, your profit loss, keep track of charts and things like that. We act as the settlement agent as it's settled to our index. And we also take care of all regulatory reporting. This is a CFTC regulated product. So we take care of all reporting on the Luxor side, and that's kind of the broad overview of the product. We can get into how miners and investors are using these products, but that's kind of the broad overview and the rationale of how the product came to be.
That's amazing. It's incredible the level of sophistication that we're getting to. in the Bitcoin mining space, and we need to be there. It's just happening much more quickly than in commodity markets in decades past. And that's probably just a function of the compression of time. There's that great book, Thank You for Being Late, about the amount of change that we see in a year is the same amount of change that the greatest generation saw in a decade. So we do have a compression of time due to this technological advances and to Moore's law and all sorts of other things. So it doesn't surprise me that we're advancing this fast, but it's really cool to see that Luxor is the one that's leading the charge here.